partner at Bain & Company, one of the knowledge partners for this conference. I lead the industrial goods and services practice, which includes power, electricity, energy, mining, and other sectors. Very pleased to have a set of panelists distinguished from different sectors, different countries, if I can say so. On my left is Nick, who heads Rio Tinto in India, has been with Rio Tinto for 32 years, long time, geologist by his undergrad training, and hopefully he'll share a lot about his past many years at Rio. Next to him is Cobus. Cobus, like me, is ex-consultant, continuing to be a consultant from BCG, and has been the founder and managing director of Beijing Access. It's a advisory firm focusing on China, commodities, procurement across the world. You've been in China for 12 years, Cobus. Next to him is Umesh. Umesh is a president at Aditya Birla Group, strategy and business development, and has been there for more than a decade, and has experience across many other Indian large firms in power and mining and other resources. So given this is a small group, what I'll try to do is I'll request the panelists to give an opening remark very quickly and open up for questions. I do have a set of questions that I'd love for the panelists to share their thoughts. But just to get us started and warmed up, I'll start with two things. First and foremost is as a follow-up to the discussion we had yesterday and this morning about natural resources and the hunger of natural resources by emerging markets. Just to give you one stat that I use commonly is that India per capita consumption of electricity is roughly 800 units per annum, whereas US is 14,000 units of electricity per annum. Canada is 17,000. Europe is 7,000 units of electricity. China is close to world average, around 2,500 to 3,000. So if you look at the energy consumption index, many of the emerging countries are way far behind the developed world. So as we think forward, as these emerging markets catch up in terms of per capita income, their consumption patterns change, their energy intensity increases, and we're not talking new emerging countries such as Indonesia or Bangladesh or Myanmar, which has a significant population. As they start to become world average in terms of consumption, what kind of pressure it will put on the natural resources. WWF did a study last year about natural resources. It talked about the kind of consumption, natural resources we are consuming around the world is 30% more than Earth can ever replenish as of today. And by 2030, we'll need 2 planets, we'll need 2 Earths to replenish all the natural resources we are consuming today. So a great discussion for us to have is to think about sustainability, but as you think about investments, how do you make sure the risks are managed? How do you make sure the geopolitical environment, the government and private-public partnership can be effectively handled? Some of those themes will come out in our discussion. So let me just start with Umesh as the opening statement, and I'll request you to keep it to 5 to 6 minutes. And then I'll request Cobus to you, and then Nick to you. And then we'll open up for questions.
Good morning, ladies and gentlemen. If we see how the overall, economy had panned out in the 20th century, it was primarily focused from more cheaper natural resources, as well as basic manufacturing, which got done in the developed economy. But the 21st century, if you see, it could be very different. If we see in the last 10 to 12 years, the way the economy has changed, or the way the natural resources sourcing, as well as the basic manufacturing, how it has changed, it has got now emerging countries coming up with a lot of natural resources which are now catering to the demands of the world economy. On the other hand, we would have the basic manufacturing also are present in the emerging countries, which is inherent to more of the cost competitiveness, and this is what is driving the overall rapid environmental growth. Now if we look at the overall emerging markets as a percentage of the global GDP, it is close to around 50%, and it is primarily driven by commodities and natural resources. So given this overall demand for natural resources going forward, this is primarily driven again by the middle class population, which is now started to consume all these natural resources. So from a group perspective, if I look at, we see that the overall demand for natural resources is going to continue in future. For the benefit of some of you who don't know about the Aditya Birla Group, we are a $40 billion conglomerate from manufacturing to services. In manufacturing, we have got interest in a whole lot of businesses, primarily in aluminum, where we cover from bauxite mining to flat roll products, the entire value chain. We are present in copper, from copper ore mining to copper smelting, as well as we are there in cement, carbon black, and whole host of businesses. Now, if we look at the overall group's revenue, 70% actually comes from the manufacturing setup which we have got. Of the 70%, around 40 to 50% are driven by raw material as well as energy, which is the primary source for this is natural resources. So there is a huge extent of dependence of a group like us, or any manufacturing company for that matter, to depend upon natural resources, and more importantly, how do they secure it. As a group philosophy, we have taken up the onus of saying that we are going to be the last man standing in every industry which we are going to be. So what is the meaning of last man standing? It means that we need to be very cost competitive, and we have to be one of the lowest cost producer in that particular industry. Now, given this particular perspective, one of the main ingredients of the overall cost, as I mentioned to you, is raw material, securing raw natural resources. Now that constitutes around 40–50% of our overall cost. So therefore, there is always a drive and strive towards looking at how we can secure our raw materials. So this is going to increase the competitiveness, and therefore, all our strategic imperatives are based on how we can achieve this core objective of last man standing.
Umesh, I do have some questions, but I'll come back to you. Let everybody cover their opening remarks. Kobus, over to you.
Thank you. I'll make my opening statements around the question of whether being endowed with resources is a blessing or a curse. We know, sitting here at the growth net, that there are new winners, new losers, large economies that are coming into existence, ferocious consumption of resources. And that, I think, will continue. But what does it mean? Many of the suppliers of resources are also in the growth net. And how can they re-engineer their own social superstructures on the back of this overall opportunity? That seems to be much harder to do than one would at first think it to be. So I think basically the resource story is fundamentally very global, and there are many new players in it, new provinces like West Africa in iron ore, in coal, Botswana, Mozambique, and you have Indonesia having really a very significant coal niche as the largest exporter of coal, but suddenly Mozambique, Botswana, Colombia are competing with that. Yet Indonesia is also a huge beneficiary in the past, so things are continuously changing. New investors. If you look at Australia, over the last 5 years, it received something like $45 billion from China, a new player, a new need for resources. Before 1993, China was a net exporter of resources. Since it's become a bigger and bigger net importer. So you might say 20 years is a long time, but this is a very big shift from the several decades before that, if you think of the last 100, 200 years. And if you think of new consumers, trade of coal 20 years ago was around Europe, Japan in Asia a little bit, then Korea a little bit, and the United States. And today, if you look at trade routes for coal, it's mostly to Asia. So if you think of China, an importer of about $2 trillion a year, roughly 21% of that is resources. You're talking about massive requirement for resources. India, even a bigger part of its imports, of course smaller imports, but close to 30% of India's imports is resources. So this is potentially a huge opportunity for those that have resources, but there's also growing competition for the opportunity, and this means that there's resource nationalism that is creeping in, and once one does it, everyone does it. Everyone is rebalancing, catching up. I think that's an important theme to make sure that as a world things work, but also for countries, and then of course one level down for local communities in the Philippines, Indonesia, certainly in countries in Africa. There's a lot of power to the governor of Katanga province to influence copper exports. Similarly, coal in Indonesia, the Philippines, copper. So big players like Rio, Xstrata, and others have learned big, expensive lessons if they don't manage at all the different layers. Tax, if you look at the tax policy changes in Australia and how many other countries in South America and Africa followed that. So it seems as if resources is seen as a big lever for benefit, policy benefit, tax benefit, but that lever must be moved very, very carefully, otherwise it can be destabilizing. The next point for me is that resources are not often outside, cities where or near ports where you can, elegantly load it onto a ship and send it off. It's deep in the jungle, it's in mountainous areas. So resources is very much an infrastructure story. And I think that makes it interesting and also makes it a developmental tool if it's done well. And it should not be about exploitation. So one of the topics I hope that we can cover is how do you take this big picture, grandiose story of the growth net and demand for resources and make it relevant for people at the grassroots level, domestic communities that will hopefully benefit from the trickle-down effect of project development. Then I think obviously we have fewer and fewer resources. We're competing for it. So sustainability is absolutely pivotal. And corporate social responsibility is a nice tagline, but is there sincerity? So I think those are just some initial thoughts to throw out. A final parting shot is that I like this word big data, but I want to introduce a new one, that's big volatility. I think that as China gets bigger and other large economies gets bigger, you're talking potentially about lower growth rates in resource demands as they mature. But the base effect, the level at which this growth happens, means that the volumes of coal, copper, iron ore, and other elemental units is so vast that if you're a country relying on that pipeline that you're supplying into a global market, or you're a company listed and you're relying on having your market share, you could really be sidelined, sideswiped, so to speak, very easily if you get it wrong. Because the movements on a quarterly, annual basis in new demand increases or decreases means that the risk for players in the sector is much bigger than ever before, which means that as CEOs and therefore countries that rely on those CEOs doing their job well need to get their story straight in an integrated manner. Otherwise you could put people in jobs, fantastic, but if they get it wrong, out of jobs. And the last 6-12 months has been a story where the cycle has reversed and unwound massively. So I think we're at a point where these questions are more pivotal perhaps than ever before.
Very good. Thank you. Nick, you touched about sustainability and community and people aspects. So
So
you want to
covered a little bit of what I
Yeah.
would. So I'll carry
build
on
on that?
from
Yeah,
there.
yeah.
There are about a billion people have benefited from the resources that the world has mined in the last 100 years. So if you're going to get 6 billion to benefit from to the same level, there's a huge demand on resources that are required, and how can one do this in a sustainable way? I heard the WWF figures, and I think that they will always come from an angle of not enough.
Yeah.
But as you can see from shale gas, there are resources that get discovered, and the human being has an amazing ability to find and innovate, etc. So I think things will change, but the sustainability of the resources sector is that there will always need to be new things found and exploration continuing to happen. The issue with, again, with sustainability of this is that the resources are no longer found outside capital cities, as you were saying. They're found in more and more remote locations. They're deeper, they're hotter, they're colder. So they're in developing countries. So you get the dynamic of how you develop those is changing as well. So the countries such as Australia and Canada, et cetera, who have had legislation and experience for many, many years, though that experience doesn't necessarily exist in the places where resources are being found today. And therefore, there is a process of countries themselves learning how not to fall into the resource curse in the development of these resources. And just with Rio Tinto, if I talk about us a little bit, we're in three countries in the world where the resource that we have has the potential of being a significant part of the GDP of the country. So, the Oyu Tolgoi deposit in Mongolia is going to be about 30% of the GDP of the country. These are huge nation-building projects that need to be done in a sustainable way so that the benefit goes to the country that you're working in and can be done for generations to come, because most of these projects are long life meaning generational projects. And therefore, the benefit has to flow on for generations. So, getting into these, to do things in a sustainable way in these, wherever you are in the world, I think that's something that every company that's working in has their way of doing it, but it is about making sure that you're accepted by the community, you have high ethical standards, high values, all those issues that go with sustainable development. But I think one of the things that we've all found is that no matter which government wants to develop something, it's the person right next to the ore body that has the ability to stop your project. So the village next door to it has far more power in a way than the nation's government. And this is wherever you are. So making sure that you work with the community and with all these big projects, or even smaller projects, to develop an ore body is 10 years from discovery to actual mining. Most of these deposits take about 10 years to develop. So you have to have a long-term picture to be able to do that, and you need to start working with your community from before you discover it, not after you've got there. So, I mean, I could go on, but
Yeah.
maybe that's enough.
No, thank you so much, Nick. Coming back to this idea about sustainability and economic benefit for the company that make the investment, Umesh, love to get your point about how Birla thinks about it, and especially one of your projects were delayed because of some of the issue that Nick talked about.
Yeah.
Could you touch upon like what kind of turmoil it creates, and does it create a reason for you to look at alternate geographies for investment which are closer to the natural resources?
Yeah. So let me give you an overview of how decision making takes place, broadly in our group. As I mentioned that more than 60-70% of our revenues come from manufacturing. So therefore, one of the most important criteria we look at is where is the natural resource and how can we secure that. And on the other hand, what we also map it is where are the markets. So depending upon which particular business it is, we look at what kind of strategy which is required to be adopted and where one should be doing the value addition. Is the value addition required to be done at the place where natural resource is present, or is it that I have to do it where the market is present? So if I were to look at the philosophy which the group has followed in terms of, let's say, making an investment in aluminum. So in aluminum especially, we have looked at investing where the natural resource is rather than on the market, because this is something where we can be much more cost competitive if we were to have our value addition done near to the bauxite mine or next to the coal mine. On the other hand, if I were to look at another example, like let's say copper, or let's say for example coal, this is how this is where we would look at how we can procure coal or copper concentrate in order to make our value addition where the market is. Whereas there is a separate business which is like cement. Cement, there the strategy would be to do value addition as well as the market would need to be at the same location, because cement is more like a local business. So therefore, for every business which we have got, the strategy is actually very, very different. Now, when we look at how we go about securing raw material resources, there how we do is basically look at primarily three criteria which we take in order to evaluate whether that particular geography or country is going to suit us in terms of our overall requirement or not. So other things remaining equal, I think what Cobus touched upon, resource nationalism, and in terms of how friendly transparency the policies are there for of that particular country becomes one of the most important criteria for us. The second one he also mentioned is about the infrastructure access, because here the important thing what has happened is now we are getting into resources which are not available near the cities, but it is available long away from the ports. So therefore, what it requires is, besides you making investment in the mine, you have to make investment on two other things, that is infrastructure build, the rail or the road to be built from that to the near to a port, as well as making a port or having a extra berth for you. So these are the kind of challenges or the investments which are required. The third one which I think the group has faced in number of occasions is manpower shortage. If I look at the kind of operations which we do in Australia, there manpower shortage is a big issue. There we have to take people to do mining by helicopters and then get them again back to cities during the weekends. So what it means is the operational cost in these kind of locations are extremely high. On the other hand, coming back to resource nationalism, if you look at the policies and the policy transparencies are not very clear in many of the locations, including India. The group had faced a huge amount of issue when we looked at what we went through in our aluminum business. When we started making our investment here in India in Madhya Pradesh, There we had got all the clearances, permits regarding the coal mine for making the mining investment and stuff like that. Therefore, we started investing in making a aluminum plant which was close to $3 to $4 billion. Very close to commissioning date, there was a letter which we received from the government of India saying that a portion of your coal, the mine which has been allocated to you and all approvals were granted to you, now it has got forest land. So therefore, we are going to withhold all the permissions which were given to you. Now look at the kind of situation one would go through if one has already made an investment of $3 to $4 billion. It is actually a national waste. It's basically, I'm not saying that one should do, mine in areas where there is forest land, but it is more important for us to know that where I am mining, whether the entire approval process and the transparency has been there or not. And if in a transparent way already the approval has been given to us, it makes, it doesn't make sense at all to again impose some kind of a regulation wherein they are restricting mining for us. So therefore, there has to be a very, very balance between what policies are we announcing versus how are we indicating to all the investors that how the policies are pro-investment. Because if the policies are pro-investment, then only it will lead into employment as well as economic growth in that particular country. If there are things like this which comes up, then any investor who would like to come to India would always have that particular apprehension in his mind. So therefore, besides India, I think all countries, even in Indonesia, the same thing which we looked at. Tata's face a brunt of, making their investment in Indonesia, and later on that policy changed where their cost went up. On the other hand, they had secured their, the power tariff which was on a fixed basis. So therefore, these are some of the issues which actually, fall into our, criteria list when we are choosing to make investment. The other thing which I would also like to state is, given that I mentioned about value addition, whether we want to do it where the market is or where the natural resource is present, in that context, as a group, we may be willing to look at making a $500 million investment in, let's say, country A. But if there is a requirement for us to make value addition even in that resource-rich country, what it means is the overall investment size is now not $500 million, but it is $3 billion. So therefore, the risk perception and the way we would like to evaluate is completely different. So therefore, this is the various mechanism and the criteria which we look at as a group before making any kind of investment, whether it is in India or globally.
So one last question from me, actually, to Nick. Gomez, will come back to you. Is that I think the same theme, like investment, making a big mining investment in billions of dollars, and you can't possibly roll back some of those decisions. If your customers are making decisions based on natural resource proximity, how do you decide like whether to keep it in advance of the demand? Is it an international market where you'll find buyers, or you look at other factors like geopolitical risk and working with the government and other factors to make up that investment beyond obviously the availability of natural resources?
It's all those things. Yeah, I mean, it's where the resources are where the resources are. So you take in all those things into account. I think what was talked about was the sovereign risk of being able to operate. I mean, we've just seen our CEO being thrown out by the shareholders because of basic sovereign risk, not taking into account and adequately sovereign risk in the investments in Mozambique. So I think sovereign risk is a clear issue wherever you are, whether it's in India. But these are countries where the resources are being found in countries where sovereign risk is much more than what we've been traditionally used to working in OECD countries. So they're things that we're going to have to learn how to work with. Yeah? But there's, obviously we do the demand and supply, and what's going to come next, and that's why part of the reason I'm in India is so that we don't miss the growth that happens in India. I mean, it's
being in the right place.
Yeah, being in the right place too.
Yeah, very true. Good. Let me just open up the panelists to the questions from the audience. So anybody, please raise your hand, and I'll. Do we have mics, please? Yeah. There's a question in the back, and then Claude will come to you.
Hi, I'm Sunny Badiga. I had a question with regards to when you do mining in foreign locations, do you end up using mostly local employees from that jurisdiction, or do you use a lot of expats? And does that have any bearing on how the whole nationalization of the resource is looked at from a government perspective? That's the first question. Second question I just wanted to comment on is if you can just comment on the debt and project financing environment for mining projects at this point in time. Thanks.
So just as far as using local employment, our endeavor is to use local employment as much as we can. I think we have targets like 90% of the employment in Oyu Tolgoi will be local employment. Similarly, and that goes most places that we work in. It does mean that you have to start very early. So you need to train people up starting, a good many years in advance of you actually getting into production. So we have many people from Mozambique from Mongolia in our operations around the world, learning how we operate so that they can go back to Mongolia and operate this mine. Yeah? So that's part of, absolutely. You have to be able, the people in the valley that you're working in are the most important. They have to get the most benefit from you being there. Yeah? So employment is clearly an important one there.
Second part of the question, do you want to take on the financing?
Yeah, just maybe to add to that point,
Yeah, sure.
It's interesting that even on the, sorry, can I?
Yeah, sure. Yeah.
Even in a home country, it can be contentious as to do you use foreign labor or not? If you look in Australia, for example, the 457 visa is constantly under debate, and that's even for Australian-owned projects in Australia. But I think certainly Chinese companies, I'm obviously been based in Beijing. We're seeing Chinese companies, which are big investors globally, having to grapple with the inability to work in other languages, in other business systems. So the natural inclination is to take a lot of management, middle management, senior management, a lot of blue-collar workers, even unskilled jobs to the markets that they go to, with a lot of pushback from grassroots and from local communities. That's just one example. I don't think Chinese are the only ones trying to do that, and they are learning and responding to the pushback. But I think that's an important point, because it in a way helps us understand to what extent is the global resource cycle helping local communities, helping the sector to be a developmental tool as much as just a business. On the financing question, it's obviously a much tougher environment now than a few years back. If you look at the end of the first quarter, third quarter last year, with all the cutbacks from the BHPs and Rios and others, that coincided with much less liquidity, much less credit extension, much more difficult listing conditions globally. And I think that continues, but it seems as if there has been a bit of a stabilization, because that was when the bad news came and one had to get used to that new reality. I think structurally we're still going to be in this period for 2, perhaps 3 years before long-term capex decisions will start to turn, hopefully, the other direction, meaning more projects being approved or putting back on stream. But at least on a shorter-term cyclical level, we're starting to see that the better second-tier companies are perhaps a bit more successful in looking at arranging financing. I was just at Mining Indaba in Cape Town, which is a gathering of 7,000, 8,000 people. That was the mood was quite positive. You know, I think it's both for the people looking for finance as well as the advisors, as well as potential investors coming back into the field. Just a little bit better mood, and I gather that the PDAC proceedings very much similar. But I think overall we need to appreciate that the super cycle instilled a kind of a false confidence that you can just build it and they will come and buy it. And therefore, if you finance it, you know, you get paid back somehow. I think, you know, mining resources forever, maybe that's a bit too long term, but for a long time to come, is far more about high-level strategy, holistic strategy for CEOs and for the governments in which they all operate, for public policy makers. And it's also, therefore, you know, about the whole value chain of the industry. We talked beforehand about the need for good marketing. That wasn't a need for some time. So I think we'll see investors and people providing capital, equity and debt, and other forms, other structures, looking very carefully at how our projects or how our conglomerates with multiple projects positioning to be able to manage that holistic set of issues. And not just saying, well, they've got a good resource, there will be demand, let's finance it. And I think, therefore, there will be great decisions and great returns for those that get it right. So if anything, that's maybe a bit more fair.
Great. Claude, you had a question.
Just one going back to, this is not only globally that for people working in, so if we have a project in Madhya Pradesh, for instance, the demand from, should it be Indian? Should it be Madhya Pradesh? Should it be Bundelkhand? Should it be the village next door to us? You know, what is local and what is, so it's quite a complex story.
Thank you. I would like to hear a little bit more from the three speakers about, in a way, the China competition for natural resources. How do you see that competition? How is it working? How is it impacting on the market? Because, of course, this is something which has been written about a lot. This is a topic that you hear a lot about. And I would love to hear you about that.
I think we discussed this question before. So do you want to take a stab at it?
Well, I think it's interesting. You say competition and you say China. There are so many different ways that China competes. Obviously, it's a consumer. And therefore, it takes price risk, supply risk, and now it influences metal exchanges and unlisted commodity prices. So it's also feeling insecure. So it's starting to go closer to the source, own the source, own the supply chain, do the project, buy minority shares in certain instances just for offtake, a bit like the Japanese did 20, 30 years ago. So it's playing such a comprehensive game increasingly in the resources sector. So when you say competition, you always have to qualify what type of competition. But the fact is that other large economies, Indonesia, if you look at legislation around power plants, exports of coal, there's also a concern, is it self-sufficient? Again, the question of local, what is local? Maybe overall, but not in a certain region. So it means that they are, with India's consumption, Africa potentially down the line, needing more resources for itself, if it can ever create an industrial base. But the fact is that China is now the new big player. And that has had so many effects. And I don't want to talk for too long, but maybe just a few ideas. You've seen, for example, India respond to that, I believe, in terms of how it engages in Africa. We've seen a re-engagement by Japan and Korea in Africa, and more recently, the Australian resource players of how they engage in Africa. That's just one axis, a China-Africa axis as an example, and I think there are many versions of that globally. Meanwhile, we're also seeing the old, call it colonial powers, Western European and American players in Africa re-look at their positions given China's rise and this response from other players in Asia. So I think it's very important, very competitive, and the new addition is that not only are there consumers and investors, but there's also now project developers. If you look at Jindal, for example, if you look at Essar, if you look at, I can say, Birla, if you look at POSCO, and one can go down a long list, they are comprehensive project players. They build the port, they build the mine, they build the railway in between, and you're looking about $4, $5, $6 billion projects. It means that your service providers that used to be, say the incumbent, say German, Italian, American, British, Japanese capital equipment suppliers are under threat, because you now have Chinese and Indian machinery and equipment going into those, a rolling stock. So with the offtake need initially, the ability to provide new forms of equity and debt from Asia, to build the project, to even own the project, means that you're in a way rearranging the entire global superstructure of old colonial powers going out and owning mines around the world. I think it was very interesting yesterday, the comment about at least we're buying it.
Yeah.
Because that is, in a way, actually very important, because the new money is from a different part of the world. The new capacity to build it, at an affordable price is from a new part of, it's not in Piccadilly Circus.
If I could, sorry, go ahead.
Just a couple of small things. I'm not a geopolitical expert in any way, but one of the things that the competition, the world's having to get used to is the money. The money is in China, so that's. But it's mostly with SOEs. So how do countries deal with a government-owned organization in their country? So I think that's one of the dynamics that it's a different type of competition. The other one is that they're now happy to get into partnerships, especially on the infrastructure side, which is a very important part of any development. And I think that you can see more and more money going into that. Yeah? So I think China has also created their ability to build cheaply has created another discontinuity in the market in the aluminium business, where they now are building smelters at a quarter of the cost of international smelters have traditionally been built at, and they're building a number of them in China currently. So the whole aluminium sector has changed dramatically, and the actual, so they've created a competition by just internally creating that volume of aluminium. So they do it in various ways. Yeah.
I was going to add a question to the question that you asked, Claude, and I want to get Umesh's your perspective. Is that one is the element of state-owned enterprises and the China Investment Council or ONGC's government-owned institutions going out of the country and buying natural resources, assets in other countries. But there's also an element of private enterprises going out and, one is owning natural resources, but for the security of fuel, and which historically has been, hey, mining is an activity done by experts, don't touch that, you buy from them. However, Tata's, Birla's, yourself, Reliance, Adani's, they've all gone backward for the sake of security of fuel. So I'd love to get your perspective in terms of, the China competition for those resources for the sake of security of fuel.
Yeah, it's very interesting, whenever we go to these kind of forums, and when we talk about natural resources or whenever there is some kind of context around China, what we do typically, and in all forums, even this one, what has happened is we compare China as a country to various companies, whether it is in India or whether it is in US or in Europe. So actually, if you see, it is basically the competition for the companies like us is not against companies of China, it is actually against China. So therefore, what you are doing is for any kind of auction process you go, for whether it is natural resources or any company you go, it's basically you would see that yes, China is over there, and the backing for that particular investment for participating in that auction stems from basically government of China, which has got huge amount of liquidity as well as resources. That is the competition which we are now talking about. So therefore, it becomes a very, very unfair advantage to a company, whether it is Birla's, whether it is Tata's, to start competing against a country where the country is looking at it more from how it can secure the raw material for the country versus we securing raw material for our company. This is essentially the difference what we are talking about in the global economy today.
In fact, it was the sense, and this expressed my question, that you are exactly addressing that. In a way, in the field of natural resources and commodities, in fact, it is one country with all the resource of one country, which is in a way competing for resources, for securing resources. And it creates, I think, quite significant distortions in the market.
Yeah, and
This is
China,
exactly the problem.
and China is doing this broadly because of two basic reasons. As I can understand, we can have a discussion around it. The first reason is, if we see the overall in China, either in any of the commodity they are present, they would be consuming more than 50% of the global requirement, or they may be producing 50% of the global requirement. That is there across all industries. So therefore, it is absolutely essential for them to remain competitive in a longer term, and that stems from securing natural resources. That is point number one. Point number two, which is also very, very important if we were to compare China versus other countries, is most of the large companies which are there in China are all government owned, whereas large companies elsewhere in the world are actually privately owned. So therefore, government plays a very, very important role in both securing raw material for the large companies, because if they don't secure that and they become uncompetitive, there is going to be huge amount of chaos in China, primarily because most of these developments or these companies are more pro-employment, pro-labor unions. They look at how they can employ more people so that there is stability in the country rather than going for competitiveness. But on the other hand, if you see securing raw material, and given that there are other components of cost being low, they are able to produce products which are at very, very competitive rates as compared to what others can produce.
Great point. Thanks. Any other questions? Sorry. Yeah.
Hello, my name is Sunil Bajpai. I am from the National Security Council Secretariat. And my question is regarding this. Some time back, there was this mineral resource rent tax was introduced in Australia. And I want to know what is its implication. Number one, in terms of government revenue. Number two, dealing with this resource nationalism. How does it impact? Does it help in addressing these issues?
Yeah, I can take. MRT was it came in a form first brought in a form that ended up with a huge reaction from the public and the investors, and the government fell over it. So it was re-looked at, and it then concentrated just on iron ore and coal, and it appears that it hasn't really worked. And I think the recent numbers that came out, there were about 250 million that was got from that resource rent tax, compared to about 3 billion that they were expecting. So I don't think it has worked, and therefore it is causing some anxiety within the Australian public because the view in general in the Australian public is that miners aren't paying enough for the resources that, or not paying enough tax for the resources they're using. So I think there's, India seemed to have copied that in some way, and other countries have done some similar things. And I think without really understanding the depth of it, the copying without understanding the depth and how it works is a risk to investors, and therefore creates anxiety in investors, and you may not get the investments that are required. But from dealing with better distribution of the wealth that's coming in from companies dealing in resources, my view is that at a super profit area, I think every company, responsible company, would expect that there should be more distribution of that super profit. But it has to be after a reasonable return for the investor has been sought. So what's happening in India is the opposite, in the sense that India already, the effective tax rate in India for the resources sector is already about 52%. If you add what is being proposed in what is similar to the resource rent tax, is 100% of royalty on top of for a community development fund, you end up being about 62+% effective tax rate in the industry, and I don't think you will get foreign investment coming in. There'll be better places to go invest the money.
You want to make a point?
Yeah.
Thanks.
On resource nationalism, just to extend what Nick mentioned, if you look at any mining project which doesn't have any kind of, let's say, infrastructure or any kind of other investments which are required, in that particular context, and under, considering that the commodity prices are at reasonable levels, no mining project is viable if the royalty and the rent taxes amount to over 45 or 50%. That is also a very, I'm taking a very, outside limit of telling about 45 to 50%, but 40% is actually the ideal way. Now, if you look at, some of the emerging countries, they have got, being rich in natural resources, one of the most important thing for them is how they can create employment as well as how they can do economic development in that country. These are the two basic agendas of the government. Okay. Now, what happens is, on top of it, if they start putting these kind of taxes and levies, what happens is, from a private investor point of view, the viability of the project goes down. Now, the government needs to come up with some kind of pro-investment policy. On one hand, it should balance how they can get foreign investment so that their overall employment as well as the economic development of the country happens. And on the other hand, if you look at, if these are pro-investment policies, most of these private miners are going to come to that particular country and do what is called as responsible mining. What it means is sharing of resources, sharing of training people, giving them employment, and contributing in a huge way to the society. And that is how, in an overall basis, the sustainable development, both for that particular country, government, as well as private company, can happen simultaneously. Otherwise, this particular thing can never happen or can never go forward.
Great point.
I have one more question. This is regarding the issue of sovereign risk. So currently, as you said, that the resources are available mostly in those countries where sovereign risk is very high. So considering from the perspective of a country like India, how do we mitigate this kind of sovereign risk for our investments in places like Africa? What could be the strategies possible?
What you're saying is, what's the advice to India to mitigate its sovereign risk in Africa? I don't think I'm qualified to talk about that, really. But I mean, sovereign risk is, I mean, the MRRT in Australia was in fact sovereign risk.
Yeah.
So it doesn't only happen in developing countries. It happens in countries that we are well established in, even. So I think the issue is that you've got to be in there. You've got to know what's happening. You've got to know what the thinking of the government is. You need to be able to have advocacy, etc., in those countries and the education of what the industry is about and how best to develop it and be part of the development of that legislation and industry. I mean, I think that's the only way that I know that you can really mitigate your sovereign risk.
Yeah. Can I add to what you said, Nick? Again, I go back to China. Okay, so let us look at the Indonesian example which we talked about. Indonesia has got the two important resources which it has got. On one hand, they have got bauxite. On the other hand, they have got huge amount of coal. Now, on the coal, they came up with this kind of restriction about the overall taxes, which made other people who have already made investment much more competitive, as well as the mining projects, some of them became unviable. Then they came up with the 51% or 49% restriction of foreign ownership. These were the kind of regulations which actually hindered any kind of foreign investment to get into Indonesia over the last 2 years. On the other hand, let us look at bauxite as an example. Bauxite, huge amounts of bauxite were actually getting exported from Indonesia to China. And China's entire smelter operations were dependent in a huge way on Indonesia. So it was not individual companies which went to Indonesia to tell them about the pro-investment policy. It was the Chinese government speaking to the Indonesian government how the policies as well as the various regulations they come up with can be much more transparent. And because of this, no kind of restrictions or very minimal kind of restrictions were imposed on bauxite, so that export of bauxite continues to happen to China. Coming back to your question, sir, it's more important that the Indian government starts making lot of relationship building with most of these natural resource countries, because that is going to save on one hand the competitiveness of all the Indian industries over here. On the other hand, it is going to save a huge amount of foreign exchange reserves, because this is going to increase, because otherwise the overall market as well as the dependence on foreign exchange is going to increase for India.
On this, I just want to change the discussion to a little bit different, and I would start with Cobus. We talked about volatility and infrastructure. Lack of one causes the excesses of the other. We talked about ownership and a lot about owning the natural resources and assets and things like that. Could you touch upon your views, having seen both China, India, and other market like Japan, where they don't have any natural resources, they import a lot of things, but they have established a mechanism to manage the volatility quite well. So, and then touch upon the infrastructure aspect that goes hand in hand.
Look, I think, back to the growth net, the level of resource consumption each new year is so much greater than what we saw in 1960s, 70s, 80s, when a lot of today's big resource conglomerates form their frameworks that they now sit on, as global leaders. So the FE elements and CO copper elements that are needed, you need an Oyo Tolgoi, and you need West African iron ore potentially down the line. Some will still dispute that, but potentially. So I think that you're seeing simply the need for bigger infrastructure projects to unlock that supply. Now, we've seen, of course, over the last year, as I said earlier, that maybe a lot of players expected just an ongoing growth story, and that has now been disappointed. But despite this fallback in confidence about the need for more resources, the medium and long-term story is still very much entrenched. So it means medium and long-term will see big mega infrastructure projects. And it means that only some can do it. Some cannot. That is clear. So how projects are put together, maybe we'll see potentially more syndications, if I can call it that, where today's enemies or competitors become tomorrow's collaborators, and where you maybe stop seeing countries as countries, but as part of a region in a continent. And you forget about the borders, and you see what is the most optimal way to build the railway through Botswana, Zimbabwe, Mozambique, and potentially even South Africa, so that an SR and a Jindal and an Exaro and a Rio and a BHP potentially share that. And I think, for me, if you look at Brazil, iron ore, how controlled it is by Vale and, others trying to get in on that, that's the one extreme. And one has a bit of that in Australia, where you have the BHPs and Rios with their own infrastructure. But then you had an FMG come into the picture and said, look, this railway is potentially open for use by others. So I think, the fact is that we're going to go into riskier, more difficult environments. We're going to have to spend more capital. We're going to have to take more risk. And maybe new models are going to be invented to make that work. I don't know if that,
great,
adds anything.
No, that's great. Thank you. Any last questions? We are about running out of time. So.
Hi, my name is Deepak Jain. I'm from Bain & Company. My question is in the context of responsible mining that you talked about, Umesh, and I'll just quote an example from Africa. I've spent a year in the infrastructure and mining sector there. What I saw on the ground was that the China's strategy of just getting in there, providing a lot of money to the government through Chinese government, and tapping the resources, taking them back to China, worked for a few years, but after that, it started to backfire for China. There is a growing resentment on the ground against the Chinese strategy. So my question is, are Chinese companies thinking about it differently, and are there any learnings for the Indian companies from that experience which they can use now?
Okay. You want to start, Kobus, and then maybe Nick, you can.
I think it's a good question, and the point was raised that you're dealing with China Inc., and then you're dealing with individual companies from other parts of the world. I think the Chinese are getting the message, but China also changes slowly and it's not so flexible. Companies realize this, they need to work better in local environments, and they're adapting the way they operate. So I think over time, the pushback from these different countries, which is a good thing, will see a new behavior, and don't underestimate that new China competing even with your new rules that you place on it, because that could be scary. But for the moment, they're constrained by the China Inc. model, where they need to have the whole value chain and command the whole value chain, because that's just not welcomed in different markets. But I actually think that we have a responsibility in, say, Africa and other developing regions, low-income areas, to make sure we have the resources, we need the infrastructure to unlock it, that we have good governance, that we make it a win-win. But the onus is on us. I'm saying this as a South African, as a person from Africa, or if I speak for developing countries in Asia and the wider world, that we literally take the game to, say, the Chinese or the Japanese or other countries. Let them come in, let them invest those dollars and develop projects, but do it in a way that creates, in a sustainable manner, that feeds the local community. And maybe, you can't have a perfect model overnight, but progressively over time, I think the onus is on us to drive projects and to shape projects in a way that it helps the development of that region. If you think, for example, the need for beneficiation in Africa, iron ore, bauxite, and copper from the copper belt, and so on and so forth. Over time, there's really an opportunity for companies like Birla that you talked about. Is there the need to process near the mine or near the market? But you know, often many countries that don't have good domestic governance, that aren't democratic, that don't have civil society, don't create a framework where you would want to invest and beneficiate. And even if no one would mind if you do that, often a thin elite at the top is trading the oil or trading the ore to China and enriching themselves as a thin elite at the top. That means no one is really at a wider level, at the bottom of the pyramid, benefiting from the riches. So back to the, is it a curse or is it a blessing? You know?
Well, I hate to do this, but we are running out of time. I just want to take this opportunity to thank Umesh, Kobus, and Nick for your valuable time. Great set of insights for us to understand and pick up from. I'd love for us to just thank the panelists with a little bit of applause for being here, and hopefully we'll see more of them. Thank you.